Adrian, hi, morning. Before we get to the global market setup, what are you making of India? We have a big Q today, the monetary policy. Do you think there will be more rate tightening? And against the backdrop of a pessimistic macro environment, what is your outlook on India now?
Yes, we do think there will be more tightening. The inflation data that came out at the beginning of the week was showing a sequential increase in core inflation. And so we would expect a reaction from the Reserve Bank. I think, though, that my outlook on India is probably more constructive than the consensus at the moment. We do see that headline inflation will begin to come off in India. The monsoon has arrived earlier. We hope we're not going to get the sort of disruption that we saw in 2010, and then there was a disruption of too much rains in 2011, which hit the sort of price of onions, etc. India, I'm afraid, is just going to have to live with higher inflation, and part of this issue with high core inflation is a degree of pricing power for businesses. And when we get a little bit more political certainty, I think business capex should remain reasonably healthy. I mean, interest rates are going up, but interest rates in real terms in India still look quite attractive.
So do you think that after the underperformance that India has seen in the first half of the year, perhaps a lot of it is already priced in and the situation could improve in the second half of 2011?
Yeah, I mean, I think you used the word priced in, and then you also mentioned underperformance. India significantly underperformed emerging markets from November through until early March, and that was at a time when the yield curve became very inverted. Monetary conditions were particularly tight and poor, plus we had the corruption scandals and a government that was unable to really make any decisions and headway. Since then, India has been performing pretty much in line with emerging markets, and I think as the correction matures, India has a good chance of outperforming emerging markets. But for now, I remain bearish, and we have been bearish on markets for 3 months now, and the markets are falling for the things that we were concerned about. And quite simply, global growth is weak. There is stagflation in developed economies, with inflation in the U.S. above 3% when household income growth is only 1%. That's why the economy is weak. People don't have the money to drive demand. Similar stories in Europe, and what's happening in the emerging world is a simpler story. It's a very normal cyclical story. We've been fighting inflation. Central banks have tightened policy, to which the idea there is to slow down growth, reduce demand, and eventually the inflationary pressures diminish. So markets were too high, and they're correcting lower. And I think this correction will continue, but at least we're facing up to the fact that growth is weak. Will continue, but at least we're facing up to the fact that growth is weak.
Well, Adrian, what are you pricing in by way of an earnings growth in the current year? There are a bunch of economists and market strategists who believe that we are going to see top line begin to dwindle in the current and the coming quarters because of interest rates and because of higher commodity prices, and eventually that will have an even bigger impact on margins, and perhaps there is a fairly substantial downgrade of earnings waiting to happen. What is the earnings growth you are working with, and how much do you think is priced in by way of an earnings downgrade?
Okay, well, there's never any way of answering that question on how much is priced in with an earnings downgrade, because you can't sort of quantitatively back these things out. It is an absolute given. It's economics 101. If governments are tightening monetary policy, that you're going to get less growth. That will cause a negative effect on operating leverage, and earnings will be revised down. We are recommending that investors are very underweight cyclical sectors at this point in emerging markets, very underweight commodity energy stocks. I think what actually happens in stock markets is the reason they're falling at the moment is that they are trying to price in lower earnings growth. The analysts typically downgrade earnings after the market has bottomed, rather than preempting it, but the market's already factoring that in. Now, I look at MSCI India, and I tend to look at it over the calendar year so I can compare it with my other markets. So we're currently going for just over 20% growth in this market. I think that number is too high, and where you need to, think about the downside risk, it would be in areas such as building materials, metals, the auto industry, particularly with the capacity that's coming on stream. These are the areas where you have your cyclical risk. In contrast, maybe some of the engineering and construction companies probably have less earnings risk to them because they tend to be much more to do with order backlog. If you look at the IT businesses, they do have a track record. They will see lower earnings, but they tend to have a track record of being able to manage adverse situations. When you then look at where would you like to be, India's got a lot of FMCG companies, which I think should do reasonably well in this environment. I also think that the banks will tend to react much more to perceptions of change in monetary policy rather than necessary to earnings. And we would expect, as India puts through maybe a couple more rate rises, you begin to see headline inflation coming off, that banks could rally at that point as the fear of further monetary tightening diminishes.
Okay. Finally, Adrian, what in your worldview would happen to commodity prices in the next couple of quarters? I guess in that would also be your assumption of whether the US will go in for a third round of quantitative easing. In any case, how are you seeing commodity prices pan out from here on? Further falls?
Personally, and this is a personal view, I'm not the commodity specialist at JP Morgan, but what I see, the delta, the information that's changing is demand is weaker. That has to be negative for commodities. I also, we've been doing a lot of demographic work on China. China has a dramatic change in its demographics, which means it needs a lot less jobs pouring concretes and building iPads. It needs to create more service sector jobs for all these graduates it produces. Its demand for commodities is going to be reducing relative to its increase in GDP. That isn't factored in by the commodity bulls. So I'm a bear on commodities, and I sincerely hope commodity prices come down, particularly the energy price, because if they don't, stagflation stays in the Western world, and that's going to be very negative for global capital markets. It's going to be very negative for dealing with these macro issues such as Greek debt restructuring, Ireland, Portugal, sorting out the 11% fiscal deficit in the United States.
Okay, so if you had to quickly...
Let us all pray for lower commodity and energy prices.
If you had to quickly sum it up for us, Adrian, after seeing such a nervous summer that global equities and markets like ours have gone through, do you think the prudent strategy would be to perhaps sit on cash, or do you think deploying the money into the downtrend would be the good thing to do?
For now, cash is a very nice thing to hold.
Okay, Adrian, thanks so much for joining us on the show.